Hello, I'm Alex Davies, founder of Wealth Club, and today I'm with Andrew Martin Smith of Guinness Asset Management to talk about their AIM EIS fund. So Andrew, for investors not familiar with Guinness, can you tell me a bit about the company and also introduce yourself?
Guinness Asset Management was set up in 2003. It's an independent asset management company focusing principally on active management of a wide variety of asset classes and investment themes. The company has 2 billion sterling plus under management, of which 200 million is invested in EIS schemes. We're based in London, in Westminster, just across the bridge here. There are 40 people in the business. I joined the business in 2005. My career has been in investments and corporate finance since 1975. I joined Guinness as a sort of senior advisor in 2005, having worked with Tim Guinness in the past. In 2013-14, we decided that we would get involved in AIM EIS schemes, and I put my hand up to manage that fund because I've always loved investing and researching smaller companies and companies which are at an early stage of their development. So in many ways it's a new trick for an old dog, but I have a young and team which works with me and keeps me out of trouble.
And what's the fund aim to do for investors? How many companies do you invest in? How does it work?
The fund wants to give investors an exposure to companies which qualify for EIS tax reliefs and are listed on AIM. These businesses come to the market via brokers. We will see almost every issue that comes on the market, which couldn't be accessed by an individual on their own. And we tend to invest in a wide spread of businesses because we believe that you should diversify risk in this area. So we would invest in up to 20 businesses probably, and try not to invest more than 10% of the fund in any one business. So what we provide for an investor is a diversified portfolio of EIS qualifying businesses, which we have some experience of running over the last 7 years.
And the idea is that I give you my money now, and then at the beginning of the new tax year, you invest that money over the following year.
Over that year. We don't invest it all at once. We would tend to stagger it over the year because we don't know who's going to be raising money from the market at any one time. So we like to have powder dry for whatever's coming all the way through from April to March next year.
So you invest in AIM companies. Are there particular characteristics of the companies you're looking for, or you just invest in AIM?
No, there very definitely are characteristics. We like to invest in companies which are occupying growing business sectors. Information technology and life sciences businesses certainly are recurring themes in our funds. We like to invest in businesses which are prepared to partner with larger businesses and maybe share some of the risk with more established businesses. A good example of that would be Director Plus, which is a graphene business which has partnered with Oakley, the leisure wear business. So that sort of business is showing a good approach to growth. We're very keen that we invest in businesses with good governance. We like to make sure that the management team has been together for a period of time, and we're also very, very keen that they're businesses which understand that we and the market need to be fed with good information, and that we're front of mind when they are thinking of doing things.
And are there any sort of red flags, companies you would avoid and reasons why you would avoid them?
I'm always criticised for having red flags, because I tend to have a few prejudices. I think business management teams that have been thrown together very quickly will be ones that we'll be very concerned about. Companies which are over dependent on on a small number of customers. That would be another concern to us. And businesses which may or may not qualify for EIS are ones that would concern us.
So tell me about some recent investments you've made and why you've made them.
Well, we are investing our 2020 fund now. There are two companies which I might mention. Roslyn Data is an interesting one. This is a business which organises and helps companies analyse large amounts of data. It came to the market in 2014-15, I think, originally, but we didn't invest in it then. We felt it was a bit early. That business has grown extremely well over the last few years. It's become much more established. It's now got 6 million of annual recurring revenues, and it's growing well this year by 20%, and will continue to grow. We think that's a really interesting business which has established itself and is moving forward well. Another business which we've invested in 2020 is One Media, which is involved in purchasing intellectual property, i.e. Music, books of composers, and that business I think has a very interesting and bright future.
And what about some older companies that you've invested in?
We do keep a track of other businesses, and also we have businesses which we've invested several times. So one of the companies that we have in our 2017 portfolio still is Way Education. That is a business we invested in at 3.5p per share. It's an online school, and of course that's very topical at the moment, but it has grown from turnover of 1 million when we invested in it to over 8 million this year, and it's providing an incredibly important service to people who are excluded from schools. It's also providing a business service to local authorities, providing online schooling for sixth form students as well. Another would be Polarian Systems, which is a business which is involved in researching pulmonary conditions. It was a spin-out from GE, the US tech giant, and came to the London market to raise funds in 2016. We have invested in this a couple of times, but we feel that the business is making very good progress. It's now got 24 installations in university hospitals in America and overseas, and if they receive regulatory approval, they'll move from being a research-based business to being one which is clinically approved, and that could be a real game changer.
And what about the pandemic? How's that affected your portfolio?
This is a question which I'm rather sort of worried about answering, Alex, because we've done extremely well as a result of the coronavirus pandemic. If I say to you that AIM has gone up 40% in the last 6 months, which is above the S&P, which is up 28%, the coronavirus has been very kind to growth companies on AIM. Our portfolios have done extremely well over the last 6 months. To give you a flavour of it, one of the portfolios was down about 30% on investment at April, and it's now flat. Another of our funds was about flat at April and is now up 80%. So it's been an extraordinary period, and as I say, tempting fate perhaps to say it's been so good, but it has. As far as Guinness is concerned, we have operated seamlessly through this period. Our fund managers have operated from home, and that has worked extremely well. And we have had access to companies who've come to raise money from us, and we can do that very well online.
And you've had a lot of exits. Have you had any recent ones?
We have been exiting. We took the position on every 3 years we exit funds as quickly as possible, so that we return money to investors. And in this time last year, we were nervous about the markets. We didn't feel that they were really valuing companies very well, so we told investors that we would be delaying until conditions were better. Well, conditions were better in the early summer, so we made a series of exits over that period. But we tend to try not to exit a company and for the 3 years while it qualifies. It's been hard to resist taking some profits on some of our businesses which have taken advantage of, which have benefited from coronavirus.
So would it be the case that as soon as you get to under normal circumstances, if you get to 3 years and you've made an investor a profit, you will sell?
We'll be more inclined to do so than if it's showing a loss, but we will only really invest when we feel that the value is reasonable. We have to be careful because the liquidity is a constraint on AIM. So, but we will tend to invest over that.
And how long has it taken for investors typically to get their money back who have been investing with you?
Our 2014 scheme has 95% of its funds back. There's one unquoted company which is still outstanding. 2015 scheme is completely returned, and about the 2016 scheme is about 85% returned, and that's happened within relatively soon, probably 4 years.
Okay. And what return are you targeting for investors?
We target to return 30% profit. It is a target, but it's very difficult to predict whether most of the risk lies in market sentiment when you come to the end of the 3 years, to be perfectly fair.
And how risky is it investing in AIM EIS?
It's less risky, I think, than people think if you're in a diversified portfolio, because these businesses are growing, and as long as they're reasonably valued by the market and achieving what they said they were going to do when they raised the money, you should be relatively well protected. Also, in comparison with perhaps other EIS schemes, these are reasonably tried and tested businesses in the sense that they've had third-party scrutiny through brokers and sponsors. So one hopes that they're reasonably seasoned by the time they come to the market. But it is a volatile market, and I as I've demonstrated, the markets can move very fast in both directions.
And to summarise, Andrew, if someone's looking to invest in an EIS this year, why should they give you some money?
Well, I believe in diversification of risk, and if you are keen on investing in smaller companies with the higher level of risk that there is associated to them, I believe AIM provides a very valuable part of a portfolio of EIS investments. It has the advantage of much greater. There's a much greater certainty of liquidity in an AIM portfolio than in a direct investment. But so I believe that it should be part of one's armour, if you like, in investing in the EIS sector.
Andrew Martin Smith of Guinness Asset Management, thank you very much.
Thank you very much, Alex.